China is not as clearly a black and white story as it used to be, which is if China's growing, that helps the world economy.
COVID now is hitting China quite hard, and this will impact the economy. However, we do see it as a positive net-net because then China will move away from COVID just like the rest of the world, and this is a positive story.
There will always come a day when we have to make big decisions about normalization. That is exactly what we are doing now, because the time is appropriate for us to do it.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
So 10 a.m. in London, 5 a.m. in New York, 6 p.m. in Hong Kong. Our top stories today. As China opens the floodgates for foreign travel, other countries say not so fast. Japan and Taiwan reimpose testing. The US is considering a similar move, warning that things could change, quote, quickly. The yen drops as the Bank of Japan announces unscheduled bond purchases, pledging once again that yield curve control will continue. And Sam Bankman-Fried, plus another executive, borrowed more than $500 million from Alameda Research to fund a stake in Robinhood. The question now is, who owns the shares? We're going to have the latest on that story. Welcome to Bloomberg Surveillance, the early edition. I'm Guy Johnson in London, Kriti Gupta and Kailey Leinz, both in New York. Anna Edwards is off. Matt Miller will be co-hosting Surveillance in the next hour with Kailey. Talking of which, Kailey, the Bank of Japan is back.
The Bank of Japan is back. Arguably, they never went away, even though we did last week get somewhat of a pivot with changes to yield curve control. But I would stress those are changes. That wasn't the evaporation of the yield curve control policy, which is why we saw action from them overnight. As for the overnight session as a whole, it was a bit mixed. You had stocks broadly lower, the MSCI Asia Pacific Index down by about 0.2%, but we did get outperformance from Hong Kong. The Hang Seng there up about 1.5% because more reopening news from that area in particular came out overnight. They are now scrapping most of their remaining COVID rules, including limits in public gatherings, as well as vaccine requirements for certain venues to enter them. So that lifting sentiment there. But broadly, the China reopening story is fueling fresh concern about inflation. That really has driven a bond sell-off globally. It started with treasuries here in the U.S. yesterday. It continued in the Asia Pacific overnight, where the 10-year Australian yield jumped 21 basis points to 4.03%. And of course, that is where the Bank of Japan comes in, takes a look at yields rising, says, no, we do want to maintain that control. So they announced more unscheduled bond buying. And that is what is driving weakness in the Japanese yen, because the BOJ at the end of the day, Kriti, is still dovish. So the yen weaker against the dollar by 0.4%, trading right around 134.
You know, and Kailey, I think that slightly stronger dollar is something that you're going to see a reversal of in the last 2 days. And this is really significant because as we talk about what's actually driving the U.S. trade, I would argue it's still the dollar. Take a look at futures. They're not doing much of anything, even though you do see a little bit of a bid into the greenback. To your point, the 10-year yield, though, also only down 1 basis point. So not seeing a ton of action in pre-market trading. That could all change as more and more people get right back to the trading desk. Really keep an eye at those opening bells. To me, I think what's really interesting here is the divergence you're seeing between risk assets. The commodity story, NYMEX crude trading at a 79 handle, down only about 0.6%. Put that in a volatility-induced context, and it isn't actually a massive move. But on the other hand, you do have futures inching just marginally higher. So it's interesting to see that you might actually see that divergence. If you actually have crude lower and stocks higher, that tells you a story in itself. Bitcoin as well, the risk sentiment perhaps a little under the weather today. To your point, Kailey, down about 0.2%. Guy, I would say nothing to write home about in U.S. market trading, but I'm going to say that and then I'm going to jinx it. So I'm just going to let you take the wheel from here.
I will take it on, but I think I'm going to continue the sentiment. Europe is open, but it's not. It's open in name, but not in spirit. You are looking at the London market up a little bit. Commodities are outperforming. France is absolutely flat. DAX is flat as well in Frankfurt. There is nothing to see here. Go to your Bloomberg terminal. Take a look at the AVAT function. What it will tell you is that volume is super light. I can attest to the fact that the trains were empty this morning. Nobody is here. Nobody is trading. So the Stock 600 is up by just a mere 0.2%. Spot 6.7 in terms of points. We're trading at 428. Dig in, though. The sector story does have a story to tell. And what you're seeing here is the basic resources sector outperforming. We were just mentioning what's happening with the energy story. Commodities, the metals, up today. UK natural gas. I know you guys have spent the last few days worrying about the weather. Over here in Europe, it is mild and it is windy. Those are perfect conditions for sustainable fuels to do their bit, for the wind turbines to work their magic, and as a result of which we are not consuming very much gas right now. So natural gas down by over 6%, Kailey.
All right, guys, speak for the vast majority of the American population right now in that we envy your mild weather because it has been a very cold and in many parts of the country brutal couple of days. Now, we do want to get back to the China story. The country's decision to abandon its COVID-0 policy and reopen its borders has prompted a global response, with other countries now considering whether to test or restrict travelers from China. Bloomberg's Alan Wan joins us now from Shanghai for the details. So, Alan, what countries are we talking about, and why are they considering imposing these restrictions?
Well, Japan was one of the first countries to come out and say that it's going to require PCR tests for travelers from mainland China. But other countries, such as the U.S., are also considering COVID precautions as well. The reason is because this concern that now that things are we've ended COVID-0, things are opening up and people can travel again, that there may be new variants emerging from all these people traveling from China. But the reality is that so far, I think Global Group came out with a study showing that the variant that's circulating around China is the same one that we're seeing around the world. And also you've got other countries such as India and Malaysia consider restrictions as well. But right now they look broader and not necessarily targeted at China. One concern people have been asking me is whether or not these new restrictions are going to curb travel from China. And from what I've seen so far, I would say no. Right now, bookings from mainland China to international locations are up 254% from yesterday morning compared with the previous day. And a lot of these folks still want to go to places like Japan, Malaysia, Singapore, Hong Kong, Macau. But what's interesting is that some of the folks want to travel to Macau and Hong Kong because they want to get the mRNA vaccine there. And also another thing that might also not discourage travel is the fact that we've got Chinese New Year coming up around January 21st. And the only thing that's probably going to inhibit travel are going to be high ticket prices.
Certainly something we're keeping an eye on. Meanwhile, in Hong Kong, they're due to end some of its last major COVID rules in a sweeping overhaul of policies aimed at reviving its reputation as a global financial center. Alan, stick with us. We're going to listen to some sound from the city's chief executive speaking about the shift.
I want to tell the world that, well, this is Hong Kong. Hong Kong is very normal now. And that is why it has come to the right time that we will do without the vaccination pass. And that is exactly what this government has been planning to do for normalization. It has come to a time where we don't have to rely on the vaccine pass.
At its core, the issue is one of the economic revival. Alan, I have to ask, how normal is Hong Kong right now?
Well, you might want to ask people in Hong Kong. I'm in Shanghai, but I was in Hong Kong last month, and for me it was not normal at all, especially that mask mandate. So right now, Hong Kong is going to end some of his last major COVID restrictions, and it's coming from mainland China. It's kind of surprising that Hong Kong is still extremely cautious. But as far as international travelers are concerned, when they arrive in Hong Kong, they no longer need to take 2 PCR tests upon arrival. Although it's suggested that they take a rapid test 5 days into their trip, and then when they leave Hong Kong, they need to take a PCR test within 48 hours or rapid tests within 24 hours, I believe. Two restrictions that have been lifted as well, and these are really important for people who live in Hong Kong. One is that they got rid of the vaccine mandate, so no longer need to show proof of vaccination when you go to public venues. And also, they got rid of the scrapping limits on public gatherings, especially in restaurants and bars. But like I said, there's still one major restriction that they still haven't lifted is the mask mandate. That's something that I was surprised at when I was in Hong Kong last month. And in terms of reopening the border, that's probably not going to happen until January 10th at the earliest. That's what the SCMP is reporting based on their sources. And John Lee said that he himself said that it's going to be a very gradual process of reopening.
Great stuff, Alan. Thank you very much. We always appreciate the updates. Bloomberg's Alan Wong joining us from Shanghai. Let's turn to what is happening with the global bond market story, which is being affected by what we've just been hearing out of China. Global debt markets extending earlier the sell-off amid concern around China reopening and the impact that that's going to have on inflation. We're starting to see yields beginning to drop back a little lower now. Let's get an update with Bloomberg's Danny Berger.
Yeah, Guy, in places like Germany, you're starting to see a sort of bid come in, but this move has been so massive, and I think it's really telling that here at the end of the year, we're not talking about a downshift coming from the Fed. It's China. That is the top concern for this macro environment and the inflationary impact that that might have. Australia reopened today. Its bond market had the first 2 days of trading off. And of course, Australia is going to be one of the markets most impacted by China since it's such a major trading partner. Yields on the 10-year, Aussie 10-year surged by 21 basis points during the trading today. But this is a global story because it's about more demand coming from China. And of course, if they're reopening, the surge in COVID cases means strains on the supply, on global shipping, things like that, concerns we had during COVID. So everything really moved higher yesterday. Germany led the sell-off. Yields there on the 10-year moved to its highest since 2011. But Guy, to your point, yes, we are seeing a little bit of bond buying, but just the whole asterisk to put on all of this, it's the last week of the year. It's been a very bad year for bonds. Weird stuff happens. Rebalancing is happening. So take all these moves with a grain of salt.
Yeah, Danny, and at its core, the BOJ playbook hasn't really changed when it comes to bond purchases, but I have to ask, how is it impacting its currency? Because that seems to be a pretty touchy point when it comes to just how successful that program is.
Right. Well, the BOJ looks at this global bond market rally that's going on, Critty, and gets concerned because they've continued to emphasize that they are having ultra easy policy. The widening of the yield curve control band, that wasn't about tightening markets. So they announced an unscheduled bond buying program today. But the other part of this, Critty, which is really to the heart of what you're asking about the movement of the yen, is they've released their minutes from that December meeting where they continue to emphasize they're not changing policy. They still want easy policy. There will not be a repeat of December. That very dovish language means that the yen is falling in today's trading versus the dollar. It's down by about 1/3 of 1%, Kailey.
All right, Bloomberg's Danny Berger, thank you so much. Now let's head over to the world of crypto. Court papers show that FTX co-founder Sam Bankman-Fried and former FTX executive Gary Wang borrowed over $500 million from Alameda Research to buy an almost 8% stake in Robinhood. Bloomberg's Ed Ledlow joins us now for more. So, Ed, it's a question now of who that stake belongs to.
Right, this is case in point for the whole FTX implosion and untangling the web of which money belongs to who and where. Caroline Ellison, who was the CEO of Alameda Research, authorized the loan to Sam Bankman-Fried for $546 million US. It was put into an entity called Emergent Fidelity Technologies, 90% of which was owned by SBF, 10% which was owned by his business partner, Gary Wang. They were used to buy the Robinhood shares. Now, according to these promissory notes and court filings which were released overnight, there are several actors trying to lay claim to this 8% stake in Robinhood. So you have FTX itself, which claims ownership of the shares. You also have BlockFi, who argue that actually Caroline Ellison, just before FTX implosion, had pledged those shares to BlockFi, which is now a bankrupt crypto lender in its own right. And then finally, you have an FTX creditor, an unnamed single FTX creditor, also trying to get hold of them. That's just one example of a tranche of money that we're trying to untangle the web and understand, all told, who actually holds it and where is it.
Let's talk more broadly.
Yeah.
As you say, the race is on now to control assets. Normally, in financial markets, if I put an asset through an exchange, I continue to own that asset.
Yes.
But in the world of crypto, that is not necessarily the case. But customers are now basically suing and saying, we should own the assets that were on exchange. They
Yes.
are ours. We put them onto the exchange. We should have control.
Not surprising that creditors are lining up to gain preferential position, right? Equity and debt investors. But this is interesting. So 4 FTX customers have sued and are seeking their suit to be converted to class action. They argue that those funds, which were customer funds, were never FTXs anyway, so they cannot go to the creditors in the first instance. They should go to the customers. It's a very straightforward argument. They argue basically that those cash and assets should be very easily traceable to the customers. The customers put them in.
Yep.
You know, FTX has a fiduciary duty to its customers to hold them, and they should go straight back. End of.
All right, a saga that is going to continue to unfold. Bloomberg's Ed Ludlow, thank you so much. Now to another corporate story we are watching this morning, Tesla. The stock's tailspin accelerated on Tuesday, falling for a 7th straight day in the longest losing streak since 2018 on a report of a plan to temporarily halt production at its China factory. The shares are now down about 69% on the year, and Tesla's market value has shrunk to roughly $345 billion, costing the company its position among the 10 highest valued in the S&P 500. And unfortunately for Tesla investors, those shares are extending their losses in pre-market trading this morning in the red, once again by about 3.3%. So a deepening of the year-to-date losses if this does continue. And interestingly, other EV makers are down in pre-market trading as well. Maybe the concerns around demand are bleeding through to some of Tesla's competitors. Rivian, Lucid Group, each down in the ballpark of 1 to 2%. And one other stock story we have continually watched over the last several days is Southwest Airlines. The disruptions from that record-breaking winter storm in the U.S. over the holiday weekend are lingering for Southwest. They say they hope the schedule will be back to normal before next week, so it could still be days of flying a reduced schedule. And analysts over at Citi say this could hit Southwest's fourth quarter results earnings by about 3 to 5%. So after a 6% drop yesterday, that stock once again down by about 1.3% before the bell today, Guy.
I would imagine passengers are looking forward to things getting back to normal fairly quickly as well, Kailey. What are we going to do next? Hugh Roberts, Quant Insights Head of Analytics, is going to be joining us a little bit later on. We're also going to be speaking to Martin Malone, Chief Economic Advisor at Alphabook. We'll get their take on what 2023 is going to look like. That's coming up. This is Bloomberg. This is Bloomberg Surveillance, the early edition. I'm Guy Johnson in London. Kruti Gupta and Kailey Leinz are both in New York. Let's talk about what's happening in the commodity market. Oil under a little bit of pressure. As everybody's been saying, it is super light volume. Take what you see on the screens with maybe a pinch of salt. But let's talk about the reopening trade in China and how it is impacting the commodity markets. To do that, we're joined on set by Eddie van der Walt, Bloomberg Markets Live Deputy Managing Editor. Eddie, let's start off. Metals equities in London higher, metals generally higher. That's the China trade. I would have thought that that would extend into the crude market as well. China lifts travel restrictions. I would have thought jet fuel would be higher. I would have thought Brent would be higher.
Yeah.
But it's not.
Right,
Why?
right. I think there's a lot of elements to the China story, right? I think number one is China reopening does not necessarily mean people will be able to travel as much as they want to because we're seeing these COVID waves and so on.
Yep.
But I think the biggest story for oil broadly and for oil products broadly is the US, right? You've got planes grounded, you've got freezing temperatures. I think that is the biggest story. If people are not driving in the US at the moment, I think that's a little bit more of a worry in the near term. But as you say, these are very thin volumes, and we won't really know what the market thinks about all of this until we get, through the first week of January.
Eddie, there's been a dynamic in the commodity market specifically where it was the ultimate kind of hedge du jour, which created a lot of macro tourism, as some people called it, into the commodity market. That has since fallen in the last couple of months. That exposure has dropped, and therefore open interest has dropped. I'm wondering if there's a pivot point that we see in 2023. What might that look like?
Yeah, Kruti, I think there's been an awful lot of tourists in commodity markets, and in commodity markets where you don't generally see them. Things like European natural gas, and I think they are very quickly looking for the exits and finding that the exits are a little bit smaller on the way out. I think if you go for a niche commodity, you've got to worry as a hedge fund that you can't get out. But that being said, commodity markets still, I think with the China reopening, are probably going to be fairly bullish going into 2023. Copper should do well. I think, commodity markets, even Brent is going to be a very, very nuanced picture. But I think if you look at the metals in particular, that's probably where the safest hedges against this new round of inflation that people seem to be worried about is to be found.
All right, Eddie Vanderwalt of Bloomberg Markets Live, thank you so much, as always. And for more market analysis from Eddie and the team, check out MLIV Go on your Bloomberg terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Guy Johnson in London. Now keeping you up to date with news from around the world, here's the first word. In western New York, the number of fatalities has risen from that record-breaking snowstorm. At least 31 people have died. The storm dumped more than 4 feet of snow on Buffalo. Meanwhile, travel is still a nightmare for thousands booked on Southwest Airlines. The carrier has already scrapped 60% of today's flights. Some stranded travelers face days of waiting. The Biden administration will comply with the Supreme Court order that keeps in place sweeping coronavirus border controls. The court ordered that the restrictions known as Title 42 stay in effect while the lawsuit goes forward. President Biden says he'll enforce the order, but believes that lifting the measure was overdue. And Bloomberg has learned that years of Donald Trump's tax returns will be released Friday by a House committee. Key identifying information such as account numbers will be blacked out. The documents will be the first complete look at the former president's tax records for the years he was running and in the White House. Coming up, we will get back to the markets from a quantitative lens. Hugh Roberts, Quant Insight Head of Analytics, will be joining us. This is Bloomberg.
This is Bloomberg Surveillance, the early edition, and here is what you need to know. As China opens the floodgates for foreign travel, other countries say, not so fast. Japan and Taiwan reimposing testing. The US is considering a similar move, warning that things could change, quote, quickly. The yen drops as the Bank of Japan announces unscheduled bond purchases, pledging once again that yield curve control will continue. And Sam Bankman-Fried plus another executive borrowed more than $500 million from Alameda Research to fund a stake in Robinhood. The question now is, who owns those shares? We're going to talk about the latest on that story. I'm Guy Johnson in London. Kriti Gupta and Kailey Leinz are both in New York. Anna Edwards is off today. Matt Miller will be co-hosting Surveillance in the next hour with the one and only Kailey Leinz. Kriti, let's talk about how we are set up for the US market opening a little bit later on. Over here, volume's a little light.
Yeah, I'm going to say the one thing you're not supposed to say on a financial network, which is not a whole lot is happening when you look at futures. We are really seeing it unchanged this morning. It's marginally green on the screen here. You are almost just shy of 0.1% higher on futures. Once again, nothing to write home about. And it's a similar story in the 10-year yield, 382. But I think what's really interesting is that you are seeing sentiment turn to the downside a little bit. And I love to look at Bitcoin and crude for that kind of indicator. The idea here, the NYMEX crude trading at a 79 handle, by the way, down about 0.4%. And really substantiated that risk sentiment turning a little bit sour, Kailey, by the Bitcoin story. Only down 0.2%. From a volatility context, neither one is showing any major signals. That just tells you people are either at home or asleep at the desk. Either one, pick your choice. But it kind of tells you that, once again, it is that light volume environment. It is that very thin liquidity environment. But let's see if it kind of picks up going into the new year.
Okay, for people at home or asleep on the desk, turn on the TV or turn on the radio. You can do something with your day and listen to Bloomberg Surveillance Early Edition, because even if it is quiet on the macro high level, there are some actual stories worth paying attention to on the micro level, including Tesla, which has been just fascinating to watch the deterioration in this stock. It was down 11% yesterday. Concerns around production in China and demand in China taking down the stock for an 8th day in a row, longest losing streak since 2018. It is now down 69% on the year, and it is adding to those losses this morning, down another 3%. So that alone is worthy of turning on your TV to hear us talk about. But it is dragging on other EV makers as well. Rivian and Lucid Group also both in the red in pre-market trading. And then lower for another day, Southwest Airlines only down about 0.6%, but that is following a 6% loss yesterday. They are still dealing with delays, reduced schedule after the winter storm over the Christmas weekend, Guy. And as a result, that stock is taking a pretty brutal punishment, Citi warning that it could mean a pretty significant hit to the company's fourth quarter results.
See, I'm with you both. It is incredibly quiet out there. Not as a lot is happening. But if you dig, you can find a few little nuggets to talk about. Let me walk you through the bigger picture here in Europe. Stock 600 doing absolutely nothing. Volume is super light. So at that level, nothing going on. But get into the sort of the sector story and you'll see what's happening with the basic resources, the miners. They're doing well. That's the China trade that seems to be having an effect today on the metals. What is interesting is it's not having that big an effect on the energy story, or at least the crude story, where actually the US shut-ins are probably a bigger factor. But what we are seeing over here is incredibly mild weather, and it's quite windy as well. Now, that is almost the perfect conditions for Europe at the moment. We need it to be mild so we don't have to turn the heating up very much. We need to keep the lights on, and the wind turbines are helping us do that. So natural gas here in the UK down by another 5%. I think this is the longest streak that we've had with gas moving lower sequentially since the war began, Chrissy.
Certainly something to keep an eye on. It's interesting to see what the kind of war hangover is going to be into 2023, of course, as the conflict rages on and continually fuels, I should say, inflation. But of course, joining us now to break down some of the impacts that we might see in 2023, Hugh Roberts, head of analytics at Quant Insight, joins us. Hugh, thank you as always for joining us this morning. I want to start with that inflationary story, because it's not just the war in Ukraine that's driving prices higher. It's also the idea of a Chinese reopening. But I have to ask, in your opinion, how much does that complicate the Federal Reserve's job?
Yeah, it makes it far trickier. But you have to admit that the Fed have been consistent throughout 2022. They were arguably late to start, but they've been pretty single-minded in terms of their fight against inflation. And they have unambiguously tightened financial conditions for the first half of 2022. We have seen financial conditions come back a little bit, and I guess now that's setting us up for arguably the key debating point in the beginning of the new year, which is the Fed once again have reiterated that when they get to kind of 5.25, whatever the terminal rate ends up being, that they will stay put, that there are no rate cuts being projected for them for the next 12 months. And of course, the money markets disagree with that and have started to discount rate cuts for the second half of next year. That really, I think, is the main battleground that we will see for bond markets, currency markets, and equities.
So is essentially what you're saying, and as at Quant Insights, you use AI to essentially measure the impact of the macro environment on financial assets. Is the Fed going to be the macro story in 2023, just like it was for the entirety of 2022, or does something else come to the fore?
Absolutely. That's really the most interesting thing from our quant work at the moment. Throughout 2022, the Fed was the number one game in town. It was all about them tightening financial conditions. And now we've got a couple of tentative signs that actually there's a regime shift unfolding underneath the surface. And we say that for a couple of reasons. One, our model confidence for US equity markets has started to fall. That means that our macro dynamics currently have started to explain less of price action in the S&P, in NASDAQ, and that's often a sign of a change in a regime. And also we're noticing a transition in terms of the key factors. So it was all about financial conditions for the last year, real yields, credit spreads, etc., strength of the dollar. And what's happening as we move into the beginning of a new year is actually real economy factors are becoming more important. We have a real GDP tracking number for the States, for China, for Eurozone. That's become more important. Industrial metals, copper, iron ore, they've become more significant drivers. So it looks like we've got fledgling signs of a bit of a regime shift away from financial conditions and towards the real economy, which will make the kind of hard versus soft landing debate probably critical.
Hugh, good morning. It's Guy. I hear what you're saying about the confidence in the model, but nevertheless, what is the model saying about mispricing?
Yeah, so at the moment, we have equities as modestly cheap, around, say, 2% below macro warranted fair value for the S&P, similar orders of magnitude for the other major indices. I think what's interesting is that the machine seems to be coming up with a bit of a barbell approach. I mean, it doesn't have a portfolio approach. It approaches each model on its own right, but it is getting bullish signals on some value stocks, some kind of energy, basic material, kind of classic cyclical plays, which would make you think, okay, maybe either the recession is delayed further or we are engineering a soft landing. But at the same time, it's also advocating bullish positions on some more defensive stocks like high dividend plays, DVY and ETF, cash cows and other ETF that tracks companies with strong balance sheets. So it seems to be a little bit of a kind of a hedged position between those two tails of the barbell.
In terms of how fat the tails are, if you look at the sort of the distribution curve, how much do you think the centre of that bell curve is going to move, and how fat are the tails relative to where they would normally be, Hugh?
I think it's such a tricky year. I mean, I know we probably say that every time, and every guest you get probably says the same kind of thing. But away from the states and the central bank reaction function and the strength or not of the real economy, really it's the topic that you guys were talking about beforehand in terms of China and how you're supposed to legislate for a bumpy reopening in China. Clearly, we all hope it's long-term positive for Chinese growth, global growth. That might, if it gets out of hand, have implications for demand for commodities and therefore the fight against inflation. But equally, it does seem to be an extremely bumpy reopening in terms of just the ability of the Chinese health authorities to cope, the increase in cases and deaths, sadly. And that could actually mean that we're going to see a reopening from a central command perspective, but actually will it change the mass population's economic behavior? So trying to legislate that from a behavioral discretionary perspective or indeed from a quant modeling perspective is just so tricky.
Well, Hugh, as we start to see these reopening steps, this kind of idea of one step forward, potentially two steps backwards that we have seen in the last couple of months from China, does that create a little bit more confidence in investing in China? What do you think?
So I think this is one where it's a classic kind of risk reward in the sense that our models were out of regime for a long time for Chinese equity markets. That was a function, obviously, Beijing and politics being more important than macro fundamentals. Our shorter-term models did pick up towards the end of last year and suggested some upside, but have now kind of leveled off and are kind of flatlining once again. I think it's really about the politics still. So trying to kind of work out from a pure quant perspective is tricky. But the chart you're showing at the moment is very interesting from our perspective because we use dollar yuan as an input. So the FX is kind of FX markets portrayal of what they think the health of China is. And that's a key input across a lot of assets, including equities. And that has emerged as the critical driver. So I guess one big takeaway from our side would be that equity people who tend to focus on company fundamentals tend to be looking at bottom-up analysis. They really need to be watching currency markets and dollar yuan in particular. It's a key indicator.
All right, Hugh Roberts of Quant Insight, thank you so much for joining us. And coming up, we'll continue the China conversation, talk about perhaps the positive implications for growth, but the potential negative implications for inflation. Martin Malone, Chief Economic Advisor at Alphabook, joins next. This is Bloomberg.
China is not as clearly a black and white story as it used to be, which is if China's growing, that helps the world economy. Now there's a lot of shades of gray in that story, and that's what bears watching.
That was Steve Sosnick, Chief Strategist at Interactive Brokers, talking about the China reopening story. Joining us now for the other factors facing the global economy in the year ahead is Martin Malone. He is Chief Economic Advisor at Alphabook. Martin, great to speak with you. If we could just start with China, because that is what has really driven the news flow over the last several days. On the one hand, there may be reason for optimism on the global growth story, but there seems to be growing concern about the implications for inflation. How do you expect China's reopening could alter that trajectory in the year ahead?
I don't think it's going to add to inflation because basically we have an excess property situation in China. We have an excess labor market situation. So the youth unemployment in China is 20%, and it's under 10% in the advanced economies. So China's job is to dramatically ease monetary and fiscal policy like we've seen in the last 6 months, and they're going to continue that policy throughout 2023. China has a large number of domestic problems which can only be solved by actually creating some sort of boom type dynamics in 2023. And that's going to be good for the rest of the world.
Good for the rest of the world, good for China. How would you stack up Chinese assets versus rest of the world assets?
Well, we went max long Chinese property 3 months ago, and everybody thought we were crazy. And I think that's delivered around 30-40% return, depending. You can play that in the bond space and the equity space. But I think the main factor of China is that the political events are now all over. They're getting a very, very cheaper energy input compared to advanced economies from the likes of Russia and Venezuela. And they've got a huge level of advantages because their interest rates are actually declining, whereas the rest of the world's interest rates are actually surging. So it's one of the only countries in the world that are actually easing macro policy.
Martin, has the easy money been made on that trade? I say easy. You had to make, obviously, a fairly big call on it. But are you going to lighten up on that position? Do you think, in terms of where the opportunities lie globally, China's had a big leg up? Do you think you're going to redeploy some of those assets elsewhere?
Not at all. It's very difficult to trade China. So other ways to trade it, for instance, we are extremely bullish Japanese stocks. We're very, very bullish the Aussie dollar. And obviously, you know, some of the commodities that China will need on a reopening. It's not like an 08, 09, 10 boom period for China where they're going to actually just build because they have excess supply of property. But their property market's going to do very well. The level of imports that they will need on the commodity space will be a lot lower than what they've previously taken in. So I don't expect a commodity boom. I don't expect an inflation response from a solid Chinese economic growth story in 2023. It's just a very, very good factor when we've got the advanced economies having a recession in 23.
But Martin, how much of that is actually priced in? It feels like the carnage you've seen in the equity markets on both sides of the Atlantic has priced in a recession already. So does that actually create some sort of bull case for American stocks or European stocks for that matter?
We're actually very bullish for US stocks. Actually, there's an 85% probability that we could get a 20% return in US stocks in 2023. But we have to factor in that we've had dramatic concentration risk during the 3 years of the pandemic. So the top 6 stocks were the star performers. America was the star performer. And this setback that we've seen in the last 12 months is very much related to concentration risk imploding, because most of the world's investors are just passive players and they're just basically playing catch up each quarter to the price action. And those will continue to lag price performance as we go forward. But recessions are actually bullish. And that's the case of all recessions except 2, the 1974 and 2002 recessions. But overall, our case is the recession in America is a bullish case for stocks, not a bearish case.
And how does the currency picture factor into that as we start to see more kind of calls for weakness in the greenback? Is that meant to be a tailwind for U.S. stocks, just given the negative correlation, or is that meant to be kind of a canary in the coal mine that maybe U.S. stocks don't actually have that much room to run?
The currency trade actually was very, very easy because we had this, the Fed made a dramatic mistake in 2021 by refusing to hike interest rates. But the markets hiked for them in 2021. In 2022, the Fed hiked over 400 basis points. That's never happened before. The Volcker period, they didn't actually use interest rates, they used reserves as their main tool. We've never seen the Fed hike 400 basis points in 1 year. So they played dramatic catch up. So it was very easy for the dollar to rally in such a scenario. But now we have peak rates, we've got peak inflation, and we've got peak dollar. It doesn't mean the dollar rally is over. We've just basically taken a pause. And the pause period is actually very, very good tailwind for corporate earnings in America.
Martin, Thank you very much indeed, Martin Malone of Alphabook. Have a very happy new year as well. Coming up, Adam Posen thinks inflation will be trending faster in 2023. A little controversial, part of our interview with the Peterson Institute president next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Guy Johnson in London. Anna Edwards is off, and Kailey Leinz joining Matt Miller for Surveillance in the next hour. Investors are hoping for a slower pace of inflation in 2023, but just how far and fast will it fall? David Weston spoke with Peterson Institute President Adam Posen about his expectations for the year ahead. Take a listen.
I think we will. David, thank you for having me during this holiday week. And actually, my views are similar to the ones Peggy was just saying, drawing on the Bloomberg economics team, a little different. But basically, I think by the time we get to a year from now, inflation is going to be clearly starting with a 3 handle, and that it's going to be clearly trending down. The issue is going to be how much more than 5.25 in February the Fed's going to have to raise, and then how much are we going to accelerate getting from 3.3, say, down to 2? Those are the questions. But I think the getting from the high inflation we are now towards 3 is pretty much baked in.
And Adam, in anticipating that favorable development, however far it goes, part of the question I guess I have is what's going to cause that? Because on the one hand, it could be improving supply chain situations. There have been some indications that is improving some the way we were told it would. How much of it is the Fed tightening?
I think it's mostly the Fed tightening. When I talk about inflation, David, I'm being a little sloppy. What I really care about is the trend or various measures of core. The Fed Open Market Committee, of course, looks at core PCE as a particular measure. I think what's important to understand is that wage inflation out of step with productivity growth is the big trend driver, even if it's lower than the rate of actual inflation, meaning a lot of workers are seeing real wage declines. That's ultimately where you see this going on. A lot of the favorable supply developments you mentioned are already in the mix, and the only thing that hasn't been fully priced in yet I shouldn't say the only thing, but the only major thing is rents, because rents are going to be coming down in line with housing prices, probably, but the rent indicators are lagging. So if we see inflation coming down further or faster in 2023, it's going to be because of Fed tightening.
That was Peterson Institute President Adam Posen speaking to Bloomberg's very own David Weston. Guy, you know, it's interesting the point that he's making here, that inflation is going to come down, but now that the focus here is shifting from the commodity inflation, shifting from the housing market into the labor market, that wage price spiral still very much a theme.
We don't get much data this week, but we do get claims, so that could be one data point to watch out for. I just wonder how this storm is going to factor into all the data as well. That's going to be something that I think is going to challenge economists. Kriti, great coverage today. It continues next. Surveillance is ahead. Kailey Leinz and Matt Miller. It's going to be a great show. This is Bloomberg.